Okay, we're going to go ahead and get started. Thank you, everybody, for joining us on our webinar talking about self-directed retirement accounts. We're lucky enough to have our guest presenter and the founder and CEO of WealthFlex, Jodi Domenico, joining us. And Joe's company is based in Bellevue, Washington, and they have self-directed retirement account clients all over the country. So Spartan Investment Group is providing an educational series. We'll have guests speak on the topic of self-directing. One of the things that I think is important to talk about on this call is that the self-directing world is somewhat new, but it's been around for a long time, but more awareness has come up to learn about self-directed retirement accounts and what you can do with investing in non-traditional assets and real estate. And we wanted to try to provide our investors and our group a little bit more awareness of some of the things that you may encounter when directing your self-directed retirement account, such as tax implications or prohibited parties and things like that. But mostly it provides you a great degree of flexibility to the call. So just a disclaimer that we always present in our projects and the deals that we fund is that we are not attorneys or accountants. We're not offering advice, so seek outside counsel. And this is obviously just a general overview of self-directed retirement accounts. And the information that we talk about is subject to change. Obviously, the tax laws were just recently overhauled, so things are very fluid all the time. And always perform your own due diligence on whatever endeavor that you jump into. So I'm going to go ahead and introduce myself. I'm Ryan Gibson. I'm the co-founder and chief investment officer at Spartan Investment Group. Spartan Investment Group is a real estate syndication and development company. A quick little briefing on what we do. We find projects all around the country. We raise investor capital for those projects, and some of our clients invest in our projects through self-directed retirement accounts. And then we operate and develop the project and pay out our investors a return. To date, we've organized about $6.5 million of private equity for real estate projects. And I personally use a self-directed retirement account, and I've done everything from invest in a self-storage development, an apartment building, and several land development projects using my self-directed retirement account. Joe, who I'll introduce here in a minute, is the co-founder and the CEO of WealthFlex. And you can see some of the things that he's done, worked formerly for Merrill Lynch. He's used his IRA to purchase a baseball park, so very non-traditional there, very interesting. Several angel investments, and just a deep knowledge of how to set up self-directed retirement accounts, and he's helped hundreds of clients set up their self-directed retirement accounts. So with that,
hi, everybody.
I'm just going to go ahead, Joe. Yeah, go ahead and chime in. Sorry, I didn't mean to jump there without saying hello. So.
Oh no, sorry, I didn't mean to cut you off. Go ahead.
No, so here we are. So I just wanted to say one more thing. Kind of the strategy of this webinar is we're going to kind of have a fireside chat set up where Joe and I both kind of collaborate and talk slide by slide. But I just wanted to make one more disclaimer because, again, we want to make sure our investors are well educated, well informed. I want to stress that, build your team before you do this. Find a CPA that's familiar with self-directed retirement account transactions and who's done them and is familiar before making a decision. Also, make sure you have legal counsel that's familiar with self-directed retirement account transactions. And then obviously know that when you make a self-directed retirement account, nobody is financially advising you from WealthFlex or from Spartan or from anywhere else. So you have to go out and set up and manage your own portfolio, which kind of is a double-edged sword in the sense that you're in control of what you make in your investments, but you're also, nobody is moving your money around and making investments for you. And again, I got to stress, perform your own due diligence. So with that, one more constraints and warning slide that I'm going to have Joe kind of jump in and talk to us about this. Joe, we have investors that have invested in our projects using their self-directed retirement accounts. And, since tax season is right around the corner, a lot of times they talk to me about, hey, do I have to do anything with my taxes, or should we be worried about the K-1s that you guys send out in the spring? Can you kind of talk a little bit more about that and kind of what requirements that the investors may have?
Sure. Yeah, so with any good opportunity, there's going to be some constraints that go along with it. And reporting is one of the things that we need to pay attention to. So the IRA is considered a non-taxable, non-reportable entity. But there are times when an IRA still needs to file a tax return. And the time that the tax return needs to be filed with the IRA happens when there's unrelated business taxable income. And here's what that is. If there is income that is happening in the IRA account that's unrelated to the purpose of the account, the purpose of the account is your retirement investments, then there's taxes to be paid on that. And the IRA needs to file what's called the 990T tax return. And UBTI for IRAs oftentimes comes up with the timing of an investment that has leverage tied to an asset that's purchased in the IRA account. So the IRA can borrow money and buy an asset, or the IRA can invest in a fund that also deploys leverage. So if that fund is a pass-through, the fund is going to send you or the IRA a K-1. And that K-1 report is going to show what income has happened from that private fund, and it's also going to show you what leverage is deployed in that fund. So if there is leverage, let's say $100 in the fund, but the fund borrows $50, and then the $150 goes out and it makes doubles its return, so now it's $300 in value. What happens is you have a $100 in gain there, $150 in gain, that is 50% leverage. So one half of the $150 in gains will be taxed, and it's taxed at the trust tax rate. So the trust tax rates actually have a little bit higher of a graduated tax scale than personal taxation does. So after you get over $1,500 in income, you're already at 39.6% taxes on the 990T return. So that's something to keep track of. It's when we're talking about reporting, we'll just talk about the 401ks, and we'll talk about the differences between the IRAs and 401ks in a minute. But right just here, we're just talking about the constraints, and one of them is reporting. With a 401k plan, the 401k each year, if the value of the 401k assets is over $250,000, the 401k must turn in a 5500 report each year. And the 5500 report, it's fairly simple. It's a couple of pages long, but it needs to be turned in. If the value of the 401k plan is less than $250,000, there's no reporting to the IRS for that plan. The IRA each year has a 5498 report. You don't have to remember these numbers, especially because the IRA, that report is turned in by the IRA custodian. So the custodian each year is turning in a report to the IRS. Yeah.
So Joe, just to kind of move it along, I think the big takeaway here is that you should absolutely be coordinating with your CPA, and when the deal puts out a K-1, just because there's a lot of information floating out there that, well, because I make a real estate investment with my self-directed IRA or self-directed 401k, it's not subject to taxes. And we just want to stress that that may not always be true. So just make sure that your accountant is aware of the investment that you're doing. And when the tax forms show up in the mail in the springtime, make sure that they have reviewed those documents to make the best decision on if what should be reported or not reported. I mean, I think that's kind of the big takeaway. Yeah. So let's jump in a little bit. Let's talk about prohibited transactions, because I think this is kind of a big thing. I mean, I'd love to buy, my dream home with my retirement account, but that is an absolutely prohibited transaction as far as me personally benefiting from the investment. So can you kind of speak to that a little bit?
Sure. So people will go online and Google search and hear some things about what you can do in your retirement plan. And sometimes people will start to believe that you can do anything in your IRA account, but that's not the case. There's prohibited transactions. And essentially, the prohibited transaction rules are fairly simple in the concepts of what they're trying to avoid with the IRA. And really, they don't want taxpayers to have a tax-advantaged account with an IRA account and then use those funds to enhance their personal lifestyle today. So you have an arm's length between your IRA. You're technically a disqualified party from your own IRA. You're also a disqualified party from your kids' IRAs or your parents' IRAs. So lineal ascendants and lineal descendants are disqualified from doing business with each other's retirement plans. And part of why the lineal ascendants and lineal descendants are disqualified parties, and brothers, sisters, aunts, and uncles are not, is because the Treasury would like to avoid people doing transactions with the next generation, because there could be a pass down of assets through that transaction, and they don't want to have to police each transaction. And what I mean by that is the death tax is an issue with the Treasury. They do expect to collect a estate tax for larger estates, and they don't want to worry about dad's IRA with $1 million building being purchased, the building being purchased by the son for $100, for example. So that's why the lineal ascendants and lineal descendants are disqualified parties. And other prohibited transactions essentially include some investments are not eligible. You can't buy collectibles, for example. You aren't able to purchase a life insurance policy, and you can't invest in an S corp with a IRA account.
Okay, great. So I think that's really important to kind of note that you can't, your children or your parents, in particular, can't benefit from an investment that you make with your self-directed account. Well, that's great. So let's jump into some things that you can do and some of the benefits to why we're all here. Again, we wanted to make everybody aware of some of your left and right limits on your self-directed retirement account, and that's why we're here today. But let's talk about some of the benefits. So, I'm looking at this: flexibility, tax deferral, checkbook control, protection from creditors, controlling your own investments, and investing in real estate, which is kind of what a lot of people do here on the call. Let's talk about what does checkbook control mean? Can you kind of just dive into what that means?
Sure. So the IRA is allowed to hold your passive investments for your retirement account. In your long-term planning, it's a very important and useful tool. There's a couple of different ways that you can purchase assets in your IRA account. One of them is to have the IRA itself purchase the investment. So the technical vesting of your IRA, for example, would be WealthFlex custodian FBO Jodi Domenico's IRA account. And that's what would be on title with the county when you go to look at who is the owner of that asset. But what is becoming more popular with people is the checkbook control. And the way that works is the IRA will own one single asset, and that is either an LLC or a trust or a C corporation. And that entity will go out and make the investments. The checkbook control is essentially you get to be appointed either the manager of the LLC or the trustee of the trust. And that trust will go out and purchase an asset. And since you're the trustee of the account, trustee of that entity, you're able to open up a bank account for that trust. Your IRA funds will flow into that bank account when your IRA purchases that trust. And as a trustee, you could sign contracts and move the funds around as needed. So the checkbook control name came up because you literally get a checkbook with your IRA account that gets to go out and participate in alternative investments.
That's great. Yeah, thanks for saying that. And I think when you're getting at to talk about some of these other things like tax deferral, largely the self-directed retirement accounts are able to experience the same tax deferred benefit that an IRA or a 401k in a traditional sense provides. Is that right?
That's right. You have all the advantages and all the constraints of any IRA at any bank, insurance company, or investment firm.
Great. So, and then protection from creditors, I think what we're getting at there is we're talking about, somebody seizing your retirement account or having access to it. Can you kind of expand just a little bit on that?
Sure. There are some new rules that have come out, the O.J. Simpson type scenario where there are situations where your IRA may be exposed to people who can access it. But for the most part, in a bankruptcy, your IRA and your 401k plan are protected. So they're not accessible and they can't be attached by lien holders and the people who get judgments against you. Essentially, it's one of the, and we're not, of course, experts on this. You'd want to talk to an attorney who is good at this type of planning, but it is a good tool for that.
Well, great. And obviously, I think the control in your own investment. I mean, you can invest in both non-traditional and traditional assets, which we'll get into, on the upcoming slides. So, moving along. So, a lot of the initial questions that we get at Spartan Investment Group is, hey Ryan, I really want to do a self-directed retirement account. Is my account eligible? And I think a reoccurring question would be for somebody who currently has a W-2 income job, and they have an employer-sponsored plan. Most situations, my understanding is, if I say, hey, my employer currently has Fidelity, it's an employer-sponsored plan, can I roll that out while I'm currently employed and do a self-directed 401k or IRA and make investments? And typically, my understanding, the answer is no. Is that right?
That's right. There's no IRS or Treasury constraint of why you can't move a 401k plan you're currently participating in. But for the most part, employers will make that a constraint in the plan documents. And usually that is because part of the cost of managing, administrating that fund is covered by the mutual fund fees that are charged. So if a Fidelity, for example, will go to Microsoft and they will offer to manage a 401k plan, if all the money comes in from salary deferrals and matching from the employer and the money goes out to the employee who is able to move it out whenever they like, the challenge for the company is it's going to be a lot more expensive to manage that 401k plan. So they usually limit it, but we've seen some companies will allow it. Boeing, for example, will allow 50% of your Boeing 401k plan to be rolled out in what we call an in-service rollover. That means you're currently employed with the company, but they will still let you roll out one half of your Boeing's VIP plan.
Gotcha. So I think number one right there kind of speaks to a previous employer account. So we're going to touch on an example here in a minute, but if you have a 401k from a previous employer and you've resigned and you've not done anything with that 401k, that could be rolled into a self-directed account. Or if you've rolled it out of that plan into a more traditional custodian such as Charles Schwab or Morgan Stanley, then those funds would then be eligible for rolling into a self-directed account. Is that right?
That's right. And in fact, the rules for 401k plans actually require the employer to allow your 401k to roll out if you'd like to after you've terminated your service. There could be some portion of your 401k plan that's not yet vested. Some employers will contribute to your 401k plan, and part of the deal is you have to stay a certain amount of time to be vested with that. So they can hold that back. But after you leave the employer that you're with, they will always roll those funds out into whatever 401k or IRA you choose.
Makes sense. And obviously, number two speaks to, if you have an IRA outside of an employer sponsored account, you can move it in. And then obviously, if you want to just start a new IRA with WealthFlex or any other self-directed custodian, you could start a new account and start making contributions to it just like you would in any IRA. Great. So let's talk about just kind of what we've talked about. And this is, kind of my example. I was with a company, we'll call it Company A, and I had an employer sponsored 401k plan. When I left Company A, I went to another company. But my 401k, I decided to roll it into a custodian of my choosing. So in this example, I'm going to use Charles Schwab to start an IRA. And later on, I decided, I'd rather use some of this retirement money and direct it towards buying non-traditional assets such as real estate. So I was able to roll my retirement account out of my custodian and roll it into WealthFlex. So that'd be kind of a perfect example of what would be eligible. So in this case, if I had to have rolled my 401k from Company A to Company B, there's probably a good chance that I wouldn't have been eligible to roll it out later on. So this just kind of gives you an example of, one of the avenues in the way that you could set up an account. So let's get into the fundamental differences because, Joe, a lot of times, people say, well, I already have a self-directed account because I'm able to pick the investments that are in my brokerage. So, I have a brokerage link with Fidelity, so I can go in and pick what investments I choose. What are some of the fundamental differences? Because I think that one of the big things is that WealthFlex allows you to invest in non-traditional assets such as real estate and has provided that conduit.
Right. Self-directed retirement plan industry coined the term self-directed retirement accounts because you're able to choose to make rental properties, private funds, precious metals. But there are, at the investment firms, there are accounts that are fully managed, which means that you don't go in and actively trade your account. You've hired an investment manager to trade that account for you, or you can engage with a Merrill Lynch or a Fidelity with a brokerage account that you are managing and you're selecting the investments. So you will see self-directed talked about with the publicly traded securities firms as well. But what we mean by self-directed when we're talking about it is that we also will allow the purchase of privately held securities as well.
Yeah, that's excellent. So we basically, the main difference is just being able to do the non-traditional assets, which is great. Okay. So this is kind of an interesting slide, but I just, I really wanted to kind of drive home, when you go on Google and you type in self-directed retirement accounts, you may come up with dozens of truly self-directed retirement account companies that will provide you with a big variety of fees and structures and what to do, what not to do. And I found that, I interviewed 5 self-directed retirement accounts before ultimately choosing WealthFlex. And I think what drove me to WealthFlex was that there was checkbook control. I didn't have to wait for a custodian to approve a transaction. The fees were generally low. And there was no necessarily annual paperwork due to my account balance size and some other things. But I also kind of saw that there was different ways you could structure your account. And so the way I understand it, Joe, is that there is always a custodian involved. And below that custodian, you can either structure this as a revocable trust or an LLC, or you can go directly to the custodian. Can you kind of elaborate on these three different setups?
Sure. So in the checkbook control arrangement, what happens is the custodian is holding on to one investment for you, and that is either your LLC or your trust. WealthFlex uses a trust structure. It's a more private document. There's advantages and there are some disadvantages to the trust structure. And we'll talk about that in a minute, but I'll address what the differences are between the different types of self-directed IRA accounts you can open up. You can also open up a self-directed IRA account where the investments are held directly by the IRA, and how the assets are vested and how they're purchased is important here, because if you have an equity trust company account and you purchase a private fund, it would be equity trust company, custodian, FBO, Jodi Domenico IRA. That is its own entity. It can go get its own tax ID number if it needed to. It has its own reporting requirement, and it could be entitled to own property or private funds. The challenge with that is that equity trust company now has to control your cash. So you will be able to go and pick out your investment, but you have to bring it to equity trust company for them to sign the purchase documents for you. And then they will have to be the ones that forward the money to the investment sponsor. And after the investment is returning dividends, let's say, the dividends need to go back into equity trust company. And then when return of principal happens, the return of principal goes back into equity trust company. That has oftentimes been found by IRA owners as overly cumbersome and oftentimes very expensive, because that's a lot of transactions that's happening within the IRA account that a custodian needs to be involved in. And each cash deposit usually has to have a deposit slip with it. Most IRA custodians, self-directed IRA custodians, don't have local branches and ATM machines, so they're usually moving papers and checks through the mail, which is cumbersome and slows people down. With the checkbook control, the custodian needs to be involved to be the single grantor of a trust, for example, in WealthFlex's case. But then after the trust is created, the trust is able to go out and open a bank account. It could even go to Charles Schwab and open up a brokerage account. So what would happen there is essentially the trust that we've created for the IRA owner is the owner of that brokerage account. And the trustee, who is the IRA owner, can go online and make those trades. It's a little bit redundant. If all you wanted to do was buy stocks and bonds, you're better off just opening up a Charles Schwab IRA account. It'll be faster and less expensive. But if you had transferred in a large dollar amount that you'd be investing in alternative investments over time, you may want a brokerage account for that period of time that cash is not going to be deployed in a private fund or real estate project. So that's why I brought that up, because it is available to people. Now, the LLC is sometimes seen as an advantage if you want to be discoverable by people. For example, if you're looking to get a loan, sometimes banks will want to go to the state and make sure that your LLC is in good standing, for example. Or they just want to be able to Google it and see that who the managers are and what the address is, and see if the LLC is in trouble or whatever they could find out about it. If you are buying private investments for your own purposes, sometimes privacy is an advantage. When you create a private trust and you Google it, you likely won't find anything on that trust. So you've got a little bit of privacy there. So the differences mainly are access to your funds in an expeditious manner, but also the fees. And then your ability to be involved and be able to react quickly in real estate is oftentimes important. We've got clients who will use their trust and go down to the county courthouse and they will buy foreclosure properties. That's difficult to do when you've got an equity trust company, self-directed IRA, that isn't able to move fast enough to participate in that type of transaction.
That's great.
Oh,
And,
I'll touch on the transaction oversight for a minute too. Yeah.
Sure. I was just going to ask you about that. Yeah, go ahead.
Good. If the custodian notices that the transaction you're about to do is a prohibited transaction, for example, if you turn in loan documents that show that you're loaning money to your father, for example, out of your IRA account, they're not going to sign those documents because they're not going to help you participate in a prohibited transaction. But the self-directed IRA custodians out there, their job is not to police your transactions or do any due diligence on your investments. So when you're making an investment with Equity Trust Company, if they happen to see it, possibly they could give you some additional transaction oversight. But I wouldn't rely on your self-directed IRA custodian to be that final policeman to approve or disapprove each of your investments for permissibility of what you can and can't do in an IRA. That's something that you really should do on your own. It's the same with WealthFlex.
Yeah, I was going to just stress that, Joe. I think that's kind of back to the slide, build your team. When you're doing these transactions, make sure that you're doing a prohibited transaction or not doing a transaction with prohibited parties. I think that's really, really important. And all of these structures necessarily do not guarantee that you're doing that, which is kind of falls back to your legal counsel and your tax counsel and the team that you set up to make sure that they're reviewing your transactions so that, you're in compliance with your personal situation. So that's great. Okay. Kind of moving along, let's talk about something that's been successful for a WealthFlex client. Jodi, do you kind of want to tell the story?
Sure. Yeah, here's a just very typical scenario that will happen with a client who will come into WealthFlex by transferring cash, and they will open up a WealthFlex account and have a trust and open up a checking account and get access to their cash, and they want to go out and do some investments. We've got a client, Cody, who came in and opened an account. He lives in Washington. He's a mortgage broker, and he sees a lot of real estate opportunities out there. And in fact, he owns his own small portfolio of rental properties, single-family residences. And he likes to buy them and do a little value add and buy the property and fix them up. And he always hires a property manager because he's so busy. And I think Cody had 6 or 7 of these in his taxable funds account, and he decided he wanted to utilize his a couple of IRA accounts. So he had a Roth IRA and a traditional IRA. I think it's Merrill Edge and a Voya, I think, where they came from. So he brought those funds in, and he purchased a property with his trust, and he went to rehab it. And before he was done rehabbing it, he was given an offer by somebody to buy it for a pretty significant profit, more than $50,000 more than he had into it. So he decided to accept the offer and just move on. And the cash went back into his trust account, and he's replenished and ready to do it again. And the most important thing, of course, it was a non-taxable, non-reportable event. So in his case, there was no leverage deployed. So all of the gains are just going to be taxed when he eventually takes the funds out of his traditional IRA. And for his Roth IRA, funds get to come out tax-free because the funds were put into that account in an after-tax basis.
That's great. Thanks. Yeah, what a great story, and I think that's kind of the advantages here that we're looking for in doing real estate transactions that somebody's maybe more familiar with than necessarily the stock market or something else. Great. So let's talk about, I get a lot of questions, Joe. When we're doing a transaction or a project, an investor may say, hey, I want to invest in your project and I want to do it through a self-directed account. Should I set up a self-directed IRA or a self-directed or solo 401k? And obviously, people know the differences between, generally the differences between maximum contributions and things like that. But can you kind of talk to the other strategies in the difference of the two vehicles?
Sure. So the IRAs are under 408 code, and the 401ks are under the 401 Treasury code. And the biggest difference for investors that we see within WealthFlex is the leverage. So, Ryan, I think you guys had a project recently that's pretty well leveraged, more than 40% leverage. Is that true?
Yeah, that's right. Specifically, we purchased an RV park that investors had the opportunity to invest in, and the purchase price for the RV park was $1.75 million, and about $900,000 of that was leveraged.
Okay. So in a situation like that, the client is better off opening up a solo 401k plan if they're eligible. And here's what I mean by that. If you own more than half of a company, and that company has employees, you will have to offer the same 401k benefits to all the employees that you're taking advantage of. So if you are self-employed without employees, you're eligible for the solo 401k. And the reason we call it solo 401k is because with yourself and your wife, who is always able to participate in your plan, with just those two people, there's nobody there to discriminate against. And with the ERISA rules, the discrimination testing is essentially they don't want the higher paid employees of a company to have more of an opportunity to invest in a retirement plan than the rank and file employees. And also, they don't want people to just indiscriminately pick and choose who they would like to be able to take advantage of the benefit. So if you're self-employed, you're able to open up the solo 401k, and it takes advantage of some safe harbor opportunities, which means that it's much less expensive for WealthFlex to administer, or any other company to administer a solo 401k, because you don't have to go through all those testing rules, top-heavy testing and discrimination testing. So the solo 401k does not pay the unrelated debt finance income taxes. So on a project like that one, Ryan, people will be better off in the solo 401k than the IRA. And you don't have to own a business. You can be a sole proprietor and open up a solo 401k plan. Each 401k must have a company sponsor. So if you're a sole proprietor and you don't have a lot of self-employment income, then you may not be able to contribute to that plan, but you're still eligible to transfer funds in from other IRA accounts and 401k plans and fund that 401k plan to make investments.
That makes sense. Yeah, and I think the other thing to kind of elaborate on is the maximum contributions. We have that larger number for 401ks. I think people are more typical and accustomed to just contributing the $18,000. I think now it's $18,500 for 2018. Can you kind of elaborate where that $54,000/$60,000 number is coming from?
Yeah, so that's the entire eligible amount. So you are able to contribute up to 25% of your self-employment income. And it comes from two different buckets. It's coming from what you're deferring as what would be your salary, and it's coming from your employer contribution. So the self-employed people out there are probably familiar with this, and you will definitely want to talk to your tax advisor when it comes to deciding how much you're able to contribute to your plan. But if you're paying yourself a salary, there's that double self-employment FICA tax and the Social Security and Medicare tax. You can't just have a business and pay yourself 100% dividend and no salary. There's always a salary that needs to be a defensible amount that you need to take out before you can start taking out your dividend. So with the solo 401k contributions, it's the total of your employer and your employee adds up to the $54,000. The salary deferral amount maximum that you can contribute is $18,500. So some people out there, like you, Ryan, you've got your regular W-2 thing going on, and then you've got your self-employment income. If you contribute your maximum of $18,500 to the airline, and then you have a solo 401k plan with your company, you wouldn't be able to contribute any more salary deferral. You'd only have employer deferral. And your employer already has contributed some of that as well. So whatever's left over is what you would be able to contribute to your sole 401k plan. And the maximum contribution limits are an aggregate of all your plans. You're not just limited to one plan that you can participate in, but your contribution limits certainly are limited by all of those plans together in aggregate.
That makes sense. Yeah, it's something to be careful with, especially if you're an investor and you have a sponsored plan within your company, and you also have a 401k plan to contribute to outside of your business. Hitting that 18,500 max as a contribution, you could be inadvertently doing it twice, and obviously that money would have to be paid back. Since you're not eligible to contribute to it. So great. Okay, so kind of moving this along, where I know we want to keep this to under an hour, and we want time for questions. Reporting requirements. I think, Joe, you and I have talked about this quite a lot. Obviously, the custodians of the accounts have annual paperwork to do, but outside of that, for your own individual IRA, it doesn't sound like you really have any annual reporting. Is that correct?
You should keep good records. No, you may not
Sure.
have to report, but you may be examined. And if you're examined by the Treasury for either your 401k plan or for your personal tax return, you likely will be asked about your retirement plans. And if you have a self-directed retirement plan, they very well may ask your transactions there. So keep a very good record of each dollar. Yeah.
So Joe, for my account, I have my account, housed at a checking account from my revocable trust. So what you're saying is, if I make, let's say, a $50,000 investment, so that money will leave my account, go to the investment, and then any return that comes back from that investment just has to be redeposited back into my revocable trust account. Is that right? And then if I were to be audited or called to provide records, I could show that the profits from the proceeds from that sale or that purchase or whatever investment I'm in are going back into my account. Is that kind of what you're getting at?
Exactly. So you don't want to have transactions that are going to you personally. So that would be a prohibited transaction and could disqualify your plan. So you would want to be able to demonstrate that you're not making prohibited transactions. You'll want to demonstrate for an IRA, for example, that when the money came in, you want to show where it came from. If it came from a loan, for example, that would suggest there is some leverage going on, and there should be an accounting of possible debt financed income. So also with the annual reporting for the IRA, it's called the 990T report for an IRA. And you may not need to file the 990T report, but you may still want to. This might sound strange to people, that why would you want to turn in a tax return when you're not required to? You may not have more than $1,000 in debt financed income or UBTI income for your IRA after expenses this particular year, but in the future when you sell an asset, you might. So if down the road, if there's still leverage tied to that particular asset and you sell it and there's leveraged income tied to that sale, you would like to have all the prior years buildup of expenses and deductions that could offset that. So you'd want to file the 990T report each year just to keep rolling forward your expenses that you may like to use for that 990T return down the road when you got the sale of the property. So again, that's why you should always keep your tax advisor involved in what your transactions are, so they could help you plan this.
That's great. So let's get into what WealthFlex does. So my understanding is that you guys are basically providing a platform that gives folks an opportunity to make alternative investments, also more traditional investments like you had mentioned earlier. And to the left, they have a little graphic. So you're basically coordinating with the custodian. You're handling all the paperwork and the documents for that. You're creating a trust agreement for the clients. And then once you've got that trust agreement, the client can decide, 401k or IRA. And then the client goes to just a bank account and opens up a revocable trust account, and then can make transactions within that revocable trust account to make investments in traditional, non-traditional assets. I mean, is that kind of a summation of what WealthFlex will do for someone?
That's right. And actually, there's no counterparty risk with WealthFlex. And what that means is WealthFlex never actually touches an IRA or 401k plan money. We facilitate these transactions. So there's a lot of things that happen in the background. We call them micro events, where we need authorization from clients, we need authorization from trustees, from banks, from investment sponsors. We like to make that as simple as we can with our electronic platform for people. But essentially what we're doing is we're allowing the transfer of funds in from a Merrill Lynch and going through a non-bank trust power that holds a cash holding account for the IRA, and immediately from that account to the Wells Fargo checking account that the client controls directly. And in doing that, there's no common trust fund that WealthFlex is responsible for managing. And it does concern me a little bit that there are so many mom and pop administrators out there that hold these common trust funds. And it feels like there's FDIC insurance, and sometimes they'll even mention that there's FDIC insurance with the cash that's held within the IRA. And that is to some degree true if the cash is truly in that bank for the benefit of the IRA holder. But a couple of years ago, there was a company called American Pension Services, one of the larger retirement plan administrators for self-direction. And when they were audited, they were found to be $25 million short in their common trust fund. And the challenge of that, sometimes there's clawbacks where people who had transferred their IRA cash out years earlier thought they were safe from that. But essentially where the clawback rules work, and not to scare people too much, but they would say that, well, the money that you received back wasn't your money, it was somebody else's money. So you can't just keep all of that. With this program, the money that goes into your Wells Fargo checking account is FDIC insured up to the $250,000 limit for each retirement plan owner. The client could literally walk in and take $500,000 in cash out of the IRA and never bring it back. What would happen is the entire IRA would be distributed to them at that point because
right.
it's a transaction to do that. So it's not advisable, but at least you know the money's there and you can see
right.
it. And we're not a huge fan of Wells Fargo in particular, but they're a very solid bank, and there is very solid and probably continued FDIC insurance for the account holders, and they've got a very good product for managing a bank account for a revocable trust. So that's why we use them as our default bank. But essentially what WealthFlex does is we coordinate each of those individual pieces. Like a client could go out and hire an attorney and write an LLC operating agreement, interview custodians, pick one, open up the IRA account with that particular equity trust company, whatever company it is, and then fill out the bi-direction letters and have the IRA purchase the LLC, then get your LLC operating agreement amended to where you are the manager of it, and then go to a bank and explain that you've got this arrangement and open up a LLC's bank account, and you'd be in the same situation. But that would take a lot of work, a lot of research, and probably more fees than you would pay in a WealthFlex program. So it's not that we thought this program up. It's been available to people since ERISA was around, and IRAs has been an opportunity. It's just that WealthFlex has come along and created an online platform that makes a lot of those smaller events happen automatically without people having to bone up and read up and become an expert in self-directed IRA administration to get their account done. So we just want to make it available for people in an easy, cost-effective manner.
Well, that's great. Yeah.
And
so to sign up, to basically go and create a WealthFlex account, they can just go to wealthflex.com and hit the links and get started and start the paperwork process. So, just to kind of reiterate what Joe is saying, I mean, he's basically allowing a platform for you to create an account, initiate the funds transfer from an existing account or start a brand new account from zero, receive the IRA, and then obviously fund a bank account. WealthFlex prefers and uses Wells Fargo a lot, but we've had clients that have set up their retirement account, their revocable trust account at a variety of different banks. Now, some banks locally may not allow it. They don't do revocable trusts, but a lot of the major banks, that we've come into contact with, like Chase and Wells Fargo, and they do actually allow revocable trust. So it just kind of depends on the bank. So to kind of bring this to under an hour, Joe, we get a lot of questions. I'm going to kind of run through this really quick so we still have an opportunity for folks to ask questions. And if people wanted to type in their questions at the bottom of the webinar, you can go ahead and start asking questions, and you can do that now while we're doing the frequently asked questions. And so that way we can get to what your question is. So Joe, just real quick, how many days start to finish to set up a self-directed IRA? And you can estimate or give a range.
Give yourself a couple of weeks. Your current custodian is an important part to this question. Some custodians like Ameriprise, Pensco Trust, for example, it will take them a few weeks before they will affect the transfer of cash and investments out of that IRA. So it may take us a little while for those, but some are very fast. Charles Schwab and Fidelity, for example, once they receive our request to transfer money into the IRA account, they do it in a few days if we select the wire option. So,
perfect.
But give yourself a few weeks. Yeah.
Okay, and I understand a 401k is a little bit faster to set up. Is that correct?
It's a little bit faster because we don't need a custodian. You appoint yourself as the trustee of your plan. So
great.
Funds will go directly from your current 401k or IRA into the bank account that we set up for the plan.
Okay. And so I think we covered current bank account for my revocable trust. Yes. Can I use my self-directed account to buy my own rental property? Yes. And I think we really hammered this home from what I heard from Joe, which is basically, you just can't live in it yourself or personally gain from it in the moment. So the other question I get too, Joe, a lot is, I don't want to roll over my whole account, just a piece of it. So can you kind of speak to that? Can you just do like a 50% or 75% of your account and roll it over?
Exactly. There's no minimum or maximum amount of a retirement plan that you're able to roll in to an IRA or 401k plan. You get to choose.
That's great. Okay, so we have a few questions coming in, which is great. And by the way, this recording will be available to everybody after, so you can listen to it again and share it and things like that. Okay, so first question, can a prior investment made outside of a 401k IRA be redesignated to a self-directed 401k? Great question.
The answer there is no. Yes, so you're only able to contribute cash, and not only that, but it must be earned income that can be deferred into a plan. So there's a couple reasons why that's not possible to move in another asset you already own outside the plan. One, you can't contribute non-earned income, and plus it would be over the contribution limit anyways, probably. And then another is your taxable funds and taxable account is a prohibited party to your IRA or 401k, so they can't do business with each other, so you can't buy things or transfer between the two.
Gotcha. Okay, next question we have, if I have a revocable trust, do I need to establish a second revocable trust?
Yeah, so we get this question a lot where clients will come in and they've got a family trust, let's say, and they just want to use that as their vehicle for their solo 401k or their IRA account. And the answer is no. The opportunity to use this structure is built within the code and the case law, and essentially it needs to be a new entity established for the purpose of holding the assets of the plan. So you need to establish a new one.
Okay. And I think somebody has asked, I think I just heard, does a 401k not require a custodian/administrator? No.
The 401k plan can hire a custodian to custody the assets of the plan, but the 401k plan needs a trustee. That trustee can be the plan owner, and that's different than an IRA account. Technically speaking, the trustee of an IRA cannot be the IRA owner. It must be a commercial bank or a non-bank trust power. It needs to be the custodian / trustee of the IRA account. 401k doesn't need a custodian, but it can have one if it wants one. And you could administer your own plan if you'd like. Most people hire an administrator to do that because there's a lot of steps involved and the signed documents are very complex. But you can certainly be the trustee of your own 401k plan, which makes you the trustee over the trust that manages the plan assets, and your administrator helps you administer the plan.
Gotcha. Okay. Don't have any other questions in the queue. We've got about 3 minutes to exactly an hour. We're waiting for a question to come in. I just wanted to conclude with how to get in touch with either myself or Joe. So Joe obviously is on the call talking about setting up self-directed retirement accounts. He runs WealthFlex. So if you wanted to set up an account with WealthFlex, there's his information. His phone number, his email is joe@wealthflex.com, or you can just go to wealthflex.com. And then obviously a plug for Spartan. If you wanted to invest in real estate with or without a self-directed retirement account, we have investment opportunities. My information is on the screen, Ryan@spartan-investors.com, or you can go to spartan-investors.com to fill out an intake form to be put on our investor distribution list. Otherwise, I don't see we have any other questions specific to self-directed retirement accounts. Scott, I see you have a question about the goldenrod, the goldenrod investment opportunity. Do you have something specific that in regard to the 401ks? I don't know if I can get you on the question, but I think we're going to go ahead and wrap up, and I can take your question outside of this call if that's okay, Scott. Thank you, everybody. Thank you so much, Joe, for your time. I really appreciate your time in helping put this together. And thanks, everybody, and have a good night.
Yep. Thanks, everybody. Bye-bye.
All right. Take care.